Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets.
Euro-dollar. Wow, what a day was yesterday. Not big in range, but very, very interesting from a technical analysis point of view. You see, for most of the day, the market had extended the range and had gone from setting up to be a daily key reversal up to a daily key reversal down. In the end, it did neither and settled on being an indecisive doji cross with a long tongue on top that was also an outside day of all things. In some ways, it could also be seen still as a somewhat vague continuation from the recent tweezer top, but it's not a great example of one. Interestingly, the cap was once again the middle tine, highlighted in red on my daily chart, and of the late November 2022 to early January bullish Andrews pitchfork, currently at 108.96, whilst the support below was again, unsurprisingly, the May 2020 low at 107.66. Now looking below this May low, we have the April 2020 low at 107.25 as the next support. Meanwhile, above, the next resistance of note past the middle tine is the 50% Fibonacci line of the January 2021 to September 2022 move at 109.44. Now, so far today, what looks right now like a possible reactionary bullish engulfing pattern, if only just, which isn't that big an ask, as the previous session was an indecisive doji cross. Cable, aka sterling against the US dollar. A second bullish white soldier yesterday and a very nice follow-on higher to the previous session's key reversal up. The action was pleasingly based on the extension of the lower trend line, currently at 122.69, and past the apex of the whole of the September 2022 to January ascending wedge pattern. To add to this, the base of the market was on the June low at 122.48, and we saw a first close since early December last year over the important 50% Fibonacci line of the June 2021 to September 22 move at 123.16. Additionally, the high yesterday challenged the highs of December, though we did not break new ground, nor do we have such a high enough close to threaten these highs. Looking below, we have further support from the Fibonacci and other closing base congestion of 121.5 zone and the May 2020 low at 120.73, which is close by the lower time, currently 120.85. Of the as yet untested early November 2022 to early January bullish Andrews pitchfork. Meanwhile, above we have resistance beyond the December last year high at 124.45, at the May to June base congestion starting in the 124.65 area up to the September 2020 low at 126.72, and within which is currently lurking the middle time, and that's currently at 126.23. And that's of the same untested bullish Andrews pitchfork. Overall, the late September to late November 2022 ascending wedge pattern is still the most relevant pattern here that continues to influence the market. I've highlighted the trend lines for this pattern in dark blue to help visualize what is going on. Prices had previously managed to reach the primary target of this pattern in the 124.20 area, though we still have open the secondary harder to reach target X3 in the 128 even area. Now, so far today, the move down, though it's not by that much, down to the 50% Fibonacci line at 123.16 before pulling back up a bit. It might be another ammunition gathering exercise, but we're early as yet. It continues to be interesting to see whether the market can stabilize and maybe even capitalize on this move higher. If so, then it needs to be done by the weekend. Euro sterling. A second bearish black crow yesterday and a very good looking follow-on lower to the previous session's combined key reversal down and bearish engulfing pattern. The overhead 50% Fibonacci line of the March 2020 to March 2022 move at 88.51 continues to work its effects upon prices. You remember this was the cap on the roof pattern that we saw back in November. What has fortified this interesting move lower is that last week was a weekly key reversal up, and this week's actions have been very much a countering period of series of actions. The move lower punched down through the previous January low, made last week at 87.67, but halted, unsurprisingly, At the combination of the April 2021 high at 87.19 and perhaps more importantly the swirling entwined mass of the medium moving average currently at 87.26 and the short medium moving average currently 87.28. Now these two moving averages had made what I'd called a mutated golden cross, with the moving averages entering the wrong way around, followed by a genuine golden cross last week. Further down, the next support is the April 2020 low at 86.69, and I'm not sure how strong that is, as it has been eroded during most of the second half of this year. So far today, a reactionary move back up, going quite a way towards making a possible bullish double, a bullish piercing pattern, or piercing line type pattern, and now even a bullish engulfing pattern, but it is still early. US dollar against Indian rupee. A second bearish black crow yesterday, and one with quite a long tongue and tail, though the body was too large to be an indecisive spinning top. However, it was not the best follow-on to the previous session's indecisive spinning top, as there was no engulfing pattern, which could have been an easy call if the market had chosen to go that way. Yet the market did drop down to be halted, unsurprisingly, by once again the key 50% Fibonacci line of the September to October 2022 move at 81.13. The top side was again pretty obviously capped by the rising medium moving average, currently at 81.72, especially on a closing basis, and also influenced by the declining short medium moving average entering the frame, currently at 81.97. That was just above. Looking below the 50% Fibonacci line, we have the interesting uptrend from the start of August 2022, currently at 18.90, which is the lower trend line of the August to September 2022 ascending triangle. Then there's nothing much until the middle time, currently at 80.38, of the October 2022 to early January 2023 bearish Andrews pitchfork, which is highlighted in dark blue on my daily chart. Meanwhile, above the medium moving average, you have the slowly declining short medium moving average, currently 81.97, with a little higher still the upper time, currently at 82.48, of the same bearish Andrews pitchfork. Even further overhead, the big pattern here is not the bearish Andrews pitchfork, though it is big enough on its own. Rather, it is the action since September 2022 to date, forming a large double top Adam and Eve type pattern. We are currently on the final leg moving lower, and this pattern will very much depend on whether the market will drop down to the neckline of this pattern, which I currently have indication as being in the 80-20 zone. It will then depend on what the market will do once and if it gets there. Now, so far today, another dip lower, but again, pulling up just short of testing this 50% Fibonacci line at 81.13. It looks a little like a hammer pattern right now, but I'm sure that will change. US dollar against the Brazilian real. A really interesting counter to the counter key reversal up. Bullish engulfing pattern, if only just on this little, and finally a bullish closing long white Maribosa. All of them seen yesterday at the same time. The key reversal on this was the really interesting bit. You see, prices had managed to punch down to a new low not seen since early November last year, down through the interesting 38.2% Fibonacci line of the June 2019 to May 2020 move at 510.87, which also has very nearby further congestion of 510.93 area, all the way down till just short of the declining middle time, currently at 505.57, and that's of the well bashed and broken July to September 2022 shallow bearish shift pitchfork. Now this pitchfork is highlighted in dark blue on my daily chart, and it had seemingly repaired itself despite the previous onslaughts. Meanwhile, on the top side, the market punched up through and closed over the long moving average, currently 517.69, the major obstacle to any rise that we've seen here for the last few days. However, that was all that it managed to achieve, as the next set of obstacles, the lesser Fibonacci line of 520.31 and the interesting 50% Fibonacci line of the March 2021 to May 2022 move, were not even touched. Yet over all this, perhaps the most interesting recent action had been what had already happened by Thursday of last week. And that was the setting up for a monthly key reversal for January. Already were set up. So if we close on the 31st of January either under 518.51, or over 528.60, then we'd be on. Anything in between and we have the lesser outside month pattern. Right now we're barely into a lesser outside month pattern. US dollar against the Mexican peso. An extraordinary piece of action here yesterday. On its own, it was a good looking key reversal up, but you take it in context, it was a complicated ballet of actions that culminated in a strong close. First off, the market dipped down, making new lows not seen since February 2020. In the process, prices extended the previous move lower, punching further under the following. The neckline of the January to May 2021 head and shoulders top, currently at 1869.49, which is highlighted in bright green on my daily chart. The lower tine of the March to July 2022 shallowly bearish shift pitchfork, currently at 1865.27, which is highlighted in dark blue on my daily chart. Finally, prices dipped down to test the lower tine, currently 1855.69, of the late September to mid-December 2022 bearish Andrews pitchfork, highlighted in bright red on my daily chart. It was at this point that the bearish incentive was seemingly overcome, as the market could not manage to punch down through it, and instead turned back up and through all the previous supports, which had become resistances and which are now again reverted to being just supports. In addition to this, the subsequent move higher punched up through the congestion at 1885.40, and most importantly, up through and closed over, and it's important, up through and closed over the broken upper tine, currently 1884.62, of the bearish Andrews pitchfork for the same March to July 2022 move. Personally, I have not highlighted this one, though I've still kept it on the daily chart. The reason for this is that it has been thoroughly broken, and I have doubts over the veracity of this pitchfork going forward. I should also point out that the earlier bearish shift pitchfork, whilst on the surface looking good, was nevertheless has not seen a test of either the upper or lower tine until now. So, whilst my confidence in this pitchfork is growing, I would at least for this week treat that lower tine with a touch of healthy doubt. As for the newer late September to mid-December 2022 bearish Andrews pitchfork, highlighted in bright red on my daily chart, the market is now closest as middle tine above, and that's currently at 1905.58. And so far today, an interesting dip down to the support at 1885.40, seemingly to gather ammunition for the subsequent rally higher. Not as large as yesterday, though, is approaching the middle tine of the bigger, older, bearish shift pitchfork.
Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.